January 10th, 2026. The U.S. Bureau of Labor Statistics releases the Nonfarm Payrolls Report. Within hours, gold explodes past $4,500 per ounce, up 0.65% on the day, up nearly 4% for the week, trading at just $42 away from the all-time record high of $4,449. Now, you might think this is just normal market reaction. Gold goes up on weak data, goes down on strong data. Simple supply and demand, right? Wrong. What happened on Friday wasn't just about one employment report. It was the confirmation of a pattern that's repeated itself before every major gold explosion in the past 50 years. A pattern so mathematically connected to Federal Reserve policy that once you see it, you cannot unsee it. And we just entered the acceleration phase. We've seen this pattern complete in 1971 to 1980. Gold went from $35 to $850. We've seen it in 2008 to 2011. Gold went from $700 to $120. We've seen it in 2018 to 2020. Gold went from $1,160 to $2,075. Every single time, the trigger was the same. Weak employment data forcing the Fed to pivot. Friday's NFP report just pulled that trigger again. The gold market operates on a four-stage mechanism tied directly to Federal Reserve policy and real interest rates. Stage 1, central banks raise rates aggressively. Gold struggles because bonds offer yield. Mainstream media calls gold a dead asset. Stage 2, economic cracks appear. Employment weakens. Housing slows. The Fed signals a pivot. Rate cut expectations build. Stage 3, real interest rates turn negative. Inflation expectations exceed bond yields. Institutional money flows into gold. Price starts accelerating. Stage 4, the Fed actually cuts rates. Dollar weakens. Liquidity floods markets. Gold explodes to new all-time highs. Retail investors finally buy at the top. This pattern has never failed to complete, not once in 50 years. Friday's employment miss just confirmed we're entering stage 3, the acceleration phase. The phase where gold moves from $4,500 to levels that will shock people who are not paying attention right now. Let me show you the proof. August 15th of 1971. President Nixon announces the U.S. is temporarily suspending dollar convertibility to gold. The gold window closes. That temporary measure is still in effect 55 years later. For 2 years, nothing dramatic happens. Gold trades between $35 and $42. Mainstream economists celebrate. The gold standard is dead, fiat currency won. Then 1973 hits, oil crisis, inflation spikes, employment weakens. The Federal Reserve faces an impossible choice. Fight inflation with high rates and crash the economy. Or accommodate inflation and let the dollar weaken. They chose accommodation. They always choose accommodation when employment is at stake. Here's what happened next. Real interest rates, that's nominal rates minus inflation, turned deeply negative. The Fed funds rate was 10%, but inflation was running at 12%. Anyone holding dollars was losing purchasing power, guaranteed. Gold doesn't pay interest, but gold doesn't lose value when currencies debase either. The calculation flipped. By 1974, gold hit $183 per ounce, a 400% increase from $35 in just 3 years. Mainstream analysts called it a bubble. They said, sell. Gold pulled back to $103 by 1976. Media celebrated. The bubble popped. Gold bugs were wrong, but the pattern wasn't complete. The Fed hadn't solved inflation. They had just paused. When employment weakened again in 1977, they resumed easing. Real rates went negative again. By January 1980, gold hit $850 per ounce, a 700% increase from the 1976 low, a 2,300% increase from where it started in 1971. Same trigger every time. Weak employment, Fed pivot, negative real rates, gold explosion. September 2008, Lehman Brothers collapses. Global financial system freezes. The Federal Reserve responds with the most aggressive monetary intervention in history. Interest rates go to zero. Quantitative easing begins. Trillions of dollars printed to stabilize markets. Gold in September 2008, $740 per ounce. The mainstream narrative? Gold is dangerous, too volatile. Treasury bonds are safe. Cash is king. But watch what the smart money did. Central banks, after 2 decades of selling gold, suddenly became net buyers. China accumulated, Russia accumulated, India imported record amounts. The institutions that understand monetary policy were positioning for what comes next. Employment data throughout 2009 and 2010 kept missing expectations. Non-farm payrolls negative month after month. Unemployment hitting 10%. Each week report confirmed the Fed would maintain zero rates. Each confirmation sent gold higher. By August 2011, gold hit $1,220 per ounce, a 160% increase from the 2008 low. Same pattern as the 1970s. Identical. Economic weakness, employment misses, Fed forced to maintain easy policy, Real rates deeply negative, gold exploding to all-time highs. The people who understood the pattern bought at $740. The people who waited for mainstream confirmation bought at $1,900. Same data, same pattern. Different outcomes based entirely on timing. The Federal Reserve is raising rates aggressively, 4 hikes in 1 year. Jerome Powell says rates are a long way from neutral. Mainstream narrative, gold is finished. Gold falls from 350 to 160. Analysts say the gold bull market is over. Higher rates mean lower gold. Simple. Then, December 2018, stock market crashes 20%. Employment data weakens. Consumer sentiment drops. Powell pivots. Within weeks, the Fed signals they're done raising rates. Gold immediately starts climbing. $1,200, $1,300, from $400. Then COVID hits in early 2020. Employment collapses. Millions of jobs lost in weeks. The Fed cuts rates to zero. Quantitative easing returns larger than ever. By August 2020, gold hits $2,075 per ounce, a 78% increase from the 2018 low. Third time in 50 years. Same pattern, same trigger, same result. Employment weakness triggers Fed pivot. Fed pivot pushes real rates negative. Negative real rates send gold to new all-time highs. The mechanism is mathematical. It's not complicated. It's not mysterious. And on Friday, January 10th, 2026, we watch this mechanism activate again. In real time. Let me break down exactly what happened on Friday and why it matters. The U.S. Bureau of Labor Statistics reported the economy added only 50,000 jobs in December. Now, some analysts pointed to positives. The unemployment rate fell from 4.6% to 4.4%. Average hourly earnings came in as expected. But here's what they're missing. The Fed doesn't wait for unemployment to spike before cutting. They cut when they see the trend changing. And the payroll trend is clearly weakening. 56,000, then 50,000, decelerating. Housing data confirmed the slowdown. Building permits fell 0.2% to 1.412 million. Housing starts dropped 4.6% month over month to 1.246 million. Interest rate sensitive sectors are cracking. Meanwhile, inflation expectations are rising. University of Michigan. Consumer sentiment showed 1-year inflation expectations at 4.22%. 5-year expectations climbed to 3.4% from 3.2%. This is the exact setup, every single time. Employment weakening, housing slowing, but inflation expectations rising. The Fed is trapped. If they cut rates to support employment, they risk reigniting inflation. If they hold rates high to fight inflation, they risk recession. History tells us what they'll choose. They always choose employment, always. And gold always wins when they do. After Friday's data, markets immediately priced in 56 basis points of Fed rate cuts for this year. The pivot is already being discounted. Gold's reaction was instant, from $4,450 to $45,729 intraday. Treasury yields stayed flat at 4.171%. The 10-year isn't rising because markets expect cuts, not hikes. The dollar index sits at 99.16, weak and getting weaker on rate cut expectations. Let me check the boxes. Employment weakening, check. Housing slowing, check. Inflation expectations rising, check. Fed pivot being priced, check. Gold breaking out, check. Institutional accumulation ongoing, check. Central banks have been net buyers for 3 consecutive years. Every single condition that preceded the 1970s explosion, the 2008 run, and the 2020 surge is present right now. But there's something different this time. The magnitude is larger. U.S. national debt, $36 trillion. Debt to GDP, over 120%. Federal Reserve balance sheet, still above $7 trillion. The monetary debasement that's already occurred dwarfs previous cycles. And the debasement coming when the Fed actually starts cutting will be larger still. Next week brings more data that will either confirm or accelerate the pattern. Tuesday, Consumer Price Index. If CPI comes in hot, it confirms the Fed's dilemma. They need to cut for employment, but can't cut for inflation. Gold wins either way because real rates stay negative regardless. Wednesday, retail sales. If consumer spending is weak, it adds pressure on the Fed to cut, more fuel for gold. Thursday, weekly jobless claims. Rising claims would confirm Friday's payroll weakness. Throughout the week, regional manufacturing surveys, Fed official speeches, each data point feeding the narrative. Here's what smart money understands. The market has already priced 56 basis points of cuts. But if data keeps weakening, those expectations will grow. 75 basis points, 100 basis points. Each increase in rate cut expectations sends gold higher. Gold at 45.07 now is telling you something. It's telling you the pattern is activating. It's telling you institutional money is positioning. It's telling you the next 12 to 24 months will look very different from the past decade. $4,149 is the all-time high. That's not prediction. That's pattern recognition based on 50 years of data. So what do you do with this information? You understand that Friday's employment miss was not random noise. It was a signal confirming a pattern that has never failed to complete in 50 years. You understand that the Federal Reserve always chooses employment over inflation when forced to pick. History proves this. 1970s, 28, 2018, every time. You understand that when real interest rates turn negative, when inflation exceeds yields, gold becomes the only asset that preserves purchasing power. This isn't opinion. This is mathematics. You understand that $4,500 gold is not the peak. It's stage 3 of a 4-stage pattern. Stage 4 is where the explosive move happens. You understand that central banks have been accumulating gold for 3 years straight. They see the same pattern. They're positioning accordingly. You understand that next week's inflation and retail data will provide more clarity. Watch the reaction. If gold holds above $4,500 on any pullback, the pattern is confirmed. You understand that when gold breaks $4,540, mainstream media will finally pay attention. They'll call it a bubble. They'll say it's too late. And history says that's exactly when stage 4 accelerates. You understand that financial awareness means seeing patterns before they become obvious. By the time everyone agrees gold is going up, most of the move is complete. This is not financial advice. This is analysis, pattern recognition based on historical data. Markets are uncertain. Prices can move in any direction. What happened in the past doesn't guarantee what happens in the future. But the pattern exists. It is repeated. The conditions that triggered it before are present right now. This is not prediction. This is pattern recognition. The same mechanism that sent gold from $35 to $850 in the 1970s. The same mechanism that sent gold from $700 to $1,920 after 2008. The same mechanism that sent gold from $1,160 to $2,755 after 2018. That mechanism is activating right now. Weak employment data, housing slowdown, rising inflation expectations, Fed pivot being priced, institutional accumulation accelerating, every box checked. While mainstream media debates whether Friday's jobs report matters, while analysts argue about soft landing versus recession, while retail investors focus on other assets, gold is quietly signaling the most important macro shift since 2020, $4,507 today, record high at $4,149 within reach. And if the pattern completes like it has every time before, significantly higher levels ahead. If you want to understand monetary policy and what it means for your financial awareness, if you want to see how these patterns develop, if you want analysis based on data rather than hype, subscribe now, turn on notifications. Because the data keeps coming. Tuesday's CPI, Wednesday's retail sales, next month's NFP, each report either confirming or challenging the pattern. Financial literacy means understanding these connections. Between employment data and Fed policy, between Fed policy and real interest rates, between real interest rates and gold. Saturaty's report just provided a clear signal. Whether you act on it or not is your decision. But now you understand the pattern that's driving these moves. And that awareness is worth more than any single trade.